Hello and welcome back. Today we're going through a question that I've been asked a few times now. How do I help the kids buy a home without putting my own money or our relationship at risk? It's something many of my clients like to do, and it always comes from the best of intentions. But when you're dealing with big sums of money, relationships, and property ownership, things can get complicated pretty quickly. So let's walk through the different ways that you can help, the risks to look out for, and how to protect both your child and yourself. My name is Melanie Davies. I'm a licensed independent financial advisor. You can find more out about me on the Financial Advisors Register, linked in the description box below. It's important to know that all of my content is general in nature and is considered general advice only. That means it's not specifically tailored for your personal financial situation. So if there's anything that you want to investigate further, always seek out an opinion from a qualified financial advisor to make sure that's appropriate for you and for your financial situation. Also, my financial services guide is available to download from the description box below. When parents help their kids buy a home, the first thing to decide is, are you gifting the money or are you lending it? Because that difference matters a lot. If you gift the money, it's gone. Legally, it becomes your child's asset. And that's fine if everything goes well. But if your child separates from their partner, then that gift can effectively become part of the couple's shared pool of assets. If you loan the money instead, it becomes a liability, something that needs to be repaid before any property settlement is divided. And that's a really important layer of protection if relationships change or your child's financial situation becomes even a little bit uncertain. The second big consideration is how to structure a family loan properly. If you do decide to treat it as a loan, make sure it's a written loan agreement prepared by a solicitor and signed by your child and their partner if they're buying it together. Make sure there's clear terms around the loan amount, the interest rate, if there is any, and when it's repayable, and ideally security over the property, either by registering a mortgage or lodging a caveat. This ensures that the contribution is legally recognised and must be repaid before the property is sold. Even if you plan to forgive the loan one day, having it properly documented now helps everyone understand where they stand. It's also really helpful if you need to show that the funds were to gift, for example, for estate planning or for settling purposes. There are also a few other options that families sometimes consider. The first option is co-ownership. So with this one, you and your child buy the property together as tenants in common. That means you each own a defined share. So maybe you own 70% and 30% is owned by them. And this can work really well if you want more control over the property. But there are downsides. So your share will count as an asset for Centrelink if you're assessed by Centrelink. And it also might attract land tax, and you'll usually have to guarantee the mortgage too. The second option is a co-ownership agreement. So if your child and their partner are buying together, a co-ownership agreement can outline how costs and the ownership are shared, and what happens if one person wants to sell or passes away, or the relationship ends. The third option is a binding financial agreement that's a little like a prenup. This one can protect your child's interests by setting out how the assets will be divided if they separate. Each person needs independent legal advice for this one to be binding. It's important not to rely on a verbal promise. A lot of families say, look, we trust each other. We just don't need the paperwork. But the reality is, without the documentation, the money can easily be seen as a gift. And that means if your child's relationship ends, the ex-partner could still receive part of what you contributed. Courts look at the overall contributions and needs of both people, not just where the funds originally came from. So having a clear paper trail, a loan agreement, security, and consistent financial treatment along the way makes all the difference if things need to be clarified. Key takeaways. Let's sum it up. If you're helping your kids buy a property, think carefully about whether it's a gift or a loan. If it's a loan, get it documented and secured properly. Always involve independent legal and financial advice for everyone involved. And think about how it fits into your estate planning and your retirement goals. And finally, have an open, honest conversation with your family about all the expectations before any money changes hands. Helping your kids into the property market can be one of the most generous things that you ever do. But a bit of structure and paperwork now can save a lot of stress later. If you found this helpful, please give this video a like and subscribe if you can. And also add a comment below with any questions that you might have or any scenarios that you'd like me to cover next time. Thanks for joining me. I'll see you in the next one.